Good afternoon, friends. We have a very special webinar on 3 different topics: one-person company, LLP, and CSR. We have a very renowned speaker, C. Vikash Jain, our own regional council member from WIRC. We welcome you, sir. Would like to request C. Abhishek Shah to formally introduce C. Vikash Jain.
Thank you, Virag. First of all, welcome Vikash Bhai once again on this platform. And as you know, all of you, that he's a very known personality in our CA fraternity. He's a regional council member of WIRC. He's a past chairman of Ahmedabad branch of WIRC. And under his chairmanship, the branch won the Best Branch Award of ICI as well as WIRC. So he's a practicing chartered accountant in Ahmedabad, and he's a very well in corporate audits as well as internal audit. So with this, I request Vikas Bhai to take the charge and start the session. Thank you, Vikas Bhai, for coming on this platform.
Thank you, Abhishek Bhai. Hello.
Yes, Vikas Bhai.
I'm audible, na?
Yes.
Yeah. Thank you, Virag Bhai and Abhishek Bhai, for organizing so many lovely webinars. And I am fortunate to be with this audience maybe for the third time. And in the last deliberation, when we had on the recent amendments in the Companies Act, we also dealt with LLP settlement scheme and the companies fresh start schemes and other amendments. It was a great response, and it was great to share my views. Today we would be discussing on the another topic which is again very important, and that is limited liability partnership. Though the act is almost 12 years old, it was is Partnership Act 2000 and LLP Act 2008, but still I would say in 2020 also there are so many myths that are there with the LLPs, and I have deliberated many times on this LLP Act, and I've seen that the awareness on this part is lacking with the members. So yes, this is a great tool. I will be discussing the things in detail today. Let me now come to the presentation part. Friends, though in our country, in India, this LLP came into being in 2008, but this is a very, very old form of doing business in the Western countries. It originated in the medieval European, in Italy as a medieval European business model, and thereafter it was again replicated in France, Germany, Great Britain, US, Japan. First time this law was codified or brought under regulation in France in way back in 1673. So I would say almost more than 350 years this has been there in France. Then in US, first codified law was there in 1822, so almost 200 years. Great Britain, it was enacted in 1867. In Germany, it was enacted in 1892, so almost more than 130 years nearby. And in Singapore also, it was enacted in the year 2005, is almost 15 years. Then in India, the need for this LLP Act is being felt for quite long time. First time in the 1957, it was suggested by the then Iron, Steel and Hardware Merchant Chambers, but then that was rejected. Thereafter, for 40 years, there was no such movement in this. And again in 1997, it was recommended by Abid Hussain Committee on the SSI, that is the Small Scale Industries. Thereafter, again after 6 long years, in 2003, Naresh Chandra Committee report, Regulation of the Private Companies and Partnerships, that highlighted that there is a big strong need for introduction of LLPs in India. Then again after 2 years, finally in 2005, J.J. Irani Expert Committee on Company Law, they recommended the introduction of the LLPs in India. Finally, in December 2006, a bill on LLP was introduced in the Parliament, but all in vain again. Then on May 1st, 2008, Union Cabinet finally gave its approval to the introduction of the new bill, that is a 2008 LLP bill, replacing the earlier bill of 2006. And finally, on October 21st, 2008, this LLP bill 2008 was introduced in Parliament. And on January 7 was the day, January 7, 2009, this President's assent was given to the LLP Bill 2008 after being passed in Lok Sabha and Rajya Sabha. And finally, on 31st of March 2009, this act was notified and this came into existence. So this is a long history, I would say. Almost it took 50 years in India also to think and then to finally implement this LLP Act. And whereas worldwide this has been in existence for long years, maybe somewhere 350 years, 400 years, this LLP Act has been. Friends, whenever we talk about LLP, I've seen that the basic definitions also at times, which are very important, we need to know first. These are also, there is lack of awareness on those definitions as well. So friends, body corporate, we need to know what is body corporate. This definition is very important so far as the LLP is concerned, and why I'll discuss with you. So 2(1)D, section 2, subclause 1, clause 1, subclause D, body corporate is defined, and what they say is body corporate means a company as defined in section 2, clause 11 of the Companies Act 13 and includes LLP registered in India or LLP registered outside India, a company registered in India and a company registered outside India, but it does not include a corporation, sole, cooperative society or any other body corporate. So to put it in a simpler way, let us understand what is a body corporate. So body corporate is nothing but any company which is registered in India or outside India, or any LLP which is registered in India or outside India. This becomes a very important definition when we especially talk about who can be a partner in a LLP. So for the time being, let us understand, barring these 4 categories, there won't be any category which would be treated as body corporate under LLP Act. So companies registered in India or outside India, and LLP is registered in India or outside India. Then financial year, there is no choice of the financial year. Financial year is compulsorily the year ending on 31st of the March. Then the section 5 becomes very important. Who can be a partner in an LLP? Friends, many times I used to receive questions whether an HUF can be a partner in an LLP, whether a cooperative society can be a partner in an LLP, whether a registered society can be a partner in an LLP. So friends, if we go by this section 5, then it is very categorically and clearly mentioned that only and only an individual or a body corporate can be a partner. So individual is a natural person, viewer understands, need not deliberate on this. And body corporate, just now we discussed, body corporate, company registered in India, outside India, and LLPs registered in India, outside India. So all in all, if we can say who can be a partner in an LLP, there are only 5 categories. One is individual and the other is LLP registered in India or outside India, and a company registered in India or outside India. So it becomes very clear. If somebody tomorrow asks you that whether an HUF can be a partner in an LLP, then our answer would be straight away no. Same way, if somebody says any AOP can be a partner, no. Any body of individuals can be a partner, no. So this is an acid test. Only an individual or a body corporate, these people can only become a partner in an LLP. Then the next important section that we need to deal with is section 11. 11 subsection 1. This deals with incorporation, and this reads as, for a LLP to be incorporated, there must be 2 or more persons. So first thing is there must be 2 or more persons associated for carrying on a lawful business. So the other thing is for carrying on a lawful business. So there cannot be any unlawful business with a view to profit. This again is very important definition, with a view to profit. So LLP must compulsorily be incorporated with a view to profit. So the object clause, the main primary object of the LLP must to earn profit. So sometimes someone asks you a question, just like Section 8 companies, earlier Section 25 under the Companies Act 1956, Section 25 companies, that is companies not for profit. So can we have an LLP for some charitable purpose, for purpose other than of earning profit, just like to further some activities of some association or some other institutions or organizations? Is it possible to have an LLP? So again, friends, the answer is clear-cut no, because an LLP can only be incorporated with a view to have profit. Yes, in the course of earning profit, we may incur loss. Profit includes loss, so that is a different story altogether. But the main objective, the main aim of the LLP for which it is being incorporated must be earning profit. So the condition itself says there must be minimum 2 persons. The purpose must be for carrying on the lawful business, and the ultimate objective should be to earn profit. If these conditions are satisfied, then yes, they can subscribe their names to the incorporation document. Then friends, those were the definitions which were very important, which I have discussed with you. Now let us understand. This is the unfortunate part with the webinar, that we cannot have two-way interactions. Otherwise, this lecture becomes very, very interesting. We have a lot of answers and questions when we discuss on the LLP. But here the limitation is I will have to be one way, and your questions can only come at the end of the session, or maybe. So you can, meanwhile, you can, whenever needed, you can please send in your queries and questions. I would be happy to answer those. So friends, what is the nature of LLP? When we discuss about the nature of LLP, let us understand that LLP is nothing but it is a hybrid form of the companies as well as the partnership forms. Why? Because all the benefits of the limited liability of company and other benefits, that is perpetual succession, separate legal entity, all such benefits of the company and all the flexibilities of partnerships are offered as a package as a LLP. So friends, we would be having all the flexibilities of the partnership firm, all the beauties of the Companies Act. At the same time, the hardships of the company would not be there in the LLP. The other beautiful thing, as I said, separate legal entity, it continues its existence irrespective of the changes in partners. So for example, there are 4 partners in a partnership firm. If one partner goes away, then there is a kind of dissolution. The continuity is not there. But in case of LLP, even if all the 4 partners, there are 4 partners, and in all the 4 partners goes away and are being replaced by some other partners, still it will be continuing as a perpetual succession, and the entity would be having this LLP would be having its separate distinct legal entity from that of its members or partners. LLP can enter into contracts and hold properties in its own name. Since LLP is a separate legal entity, so it can enter into contracts at its own and not in the name, necessarily in the name of the partners. And then it can also hold properties in its own name. Here, the liability of the partners is limited to the agreed contribution. So section 32 speaks about the agreed contribution. This is just like the capital in case of a company. So for example, tomorrow, if we are incorporating a company, LLP, and if the amount agreed to be contributed is, for example, say 10 lakhs, then the liability would be limited to 10 lakh rupees and not beyond that. So the concept of limited liability is robbed in. Then this LLP concept, this exists in UK, US, Australia, Singapore, and various other Gulf countries as well. And Indian LLP Act is based on the model of UK LLP and Singapore LLP Act 2005. In India, earlier, when the LLP Act was being planned, it was thought that it should only be for the professionals. So only the professionals would be allowed to incorporate LLP for their purpose. But subsequently, they thought, you know, It is very much important for the MSMEs as well. So then when the act came into existence, it was open for both professionals as well as non-professionals. So even the businessmen, they can also incorporate LLP for that. They can set up. Friends, the most important element in the entire LLP Act is the LLP agreement. I would be saying that LLP agreement is the essence of any LLP. This is covered by Schedule 1. Friends, if the LLP agreement is not there, in absence of the LLP agreement, the Schedule 1 of the LLP Act would be applicable. So all in all, Schedule 1 covers total 13 points. So if we do not have the LLP agreement, then all those 13 points will replace our LLP agreement and our LLP would be driven as per Schedule 1. So it is very important then we need to have LLP agreement, because those 13 points may not suit our case, may not suit our LLP. And again, while drafting the LLP agreement, we need to be very clear and categorical so as to see that all those 13 points are addressed in our LLP agreement. What happens tomorrow, friends? If out of those 13 points, 4 points are addressed in our LLP and in our LLP agreement, and our agreement is silent on the rest of the 9 points, then friends, what happens? Those 9 points will be applicable from Schedule 1, and what those 4 points that have been mentioned in our agreement would be applicable. So whichever point on which our agreement is silent, that would be picked up from the LLP agreement, LLP Schedule 1, and then that would be applicable to that extent. So we need to be very, very careful while drafting the LLP agreement. And the other thing is, what the practice that I've seen in most of the cases, we people are having very casual approach while drafting the LLP agreement. Most of the time what happens, you would be having a draft of the LLP agreement without just going into the nitty-gritties of the or understanding the business of the people who wants to set up the LLP. We would simply be asking for the few basic information that is required, maybe like what would be the name of the LLP, who would be the partners, what is their profit sharing and all these things, and what would be the object clause of the LLP, 5-6 things, and then based on these we used to have that stereotype thing kind of agreement, and cut, copy, paste in the LLP agreement is normally being drafted. So that is not advisable at all, friends. We need to, because see, if this is the approach, then we cannot earn a fee also from our clients, because client would also understand that what the value addition that we are delivering. So LLP agreement is a place where we can do lot of value addition, where we can apply our this knowledge and can be a great this value addition to our clients. Friends, we need to sit with the client, we need to understand normally what the business is all about, how they would be conducting the business, what would be the relations amongst the partners, which partner would be doing what, how the profit sharing needs to be, okay, and what is the expertise of the different partners, and there may be n number who would be operating the bank accounts. There will be n number of things. When we sit with the client, we can understand what kind of things that they need to have in their business, what are their plans, and all these things. If we can understand accordingly, we can always suggest them or guide them or advise them to have the LLP agreement accordingly. So friends, it is my sincere advice that we need to have a very thorough discussion with our clients, and then only the LLP agreement should be drafted. Otherwise, what happens normally, just like any other partnership did, while we are sipping a cup of tea, our team, somebody sitting outside our cabin, he would be, while we are having a sip of tea with our client, they would be coming up with the agreement. And that is where the client never also never values us. He thinks कि इसमें क्या है, चाय पिया तब तक तो एग्रीमेंट बन के आ गया, इसकी तो कीमत ही क्या है, and they never value us, and then they won't be giving us the fee also, which we otherwise can command. So friends, as I said, there are total 13 points in the Schedule 1 of the LLP agreement, and we needs to address all those 13 points, which I'll come in the next or cover in the next slide. So what is LLP agreement? LLP agreement is a written agreement between the partners of the LLP and the LLP, which determines the mutual rights and duties of the partners and their rights and duties in relation to that LLP. So friends, what is the LLP agreement? LLP agreement is a written piece of document, is an agreement between the partners of the LLP and the LLP, and it also determines the mutual rights and duties of the partners and their rights and duties in relation to that LLP also. So friends, why this becomes important? Because the rights and duties of the partners needs to be defined in this LLP agreement. Otherwise, there may be chaos. Which partner would be doing what? One partner may be having expertise in some particular field. One may be expert in purchase. Other may be expert in sales. Somebody may be expert in marketing. So there is no overlapping of such kind of things. So you can very well define the things also. Who would be operating the bank account? Else, what will happen if there are three partners? So there will always be a question who would be, so all the three signature would be required. Means that whenever you operate a bank account or open a bank account, again, or the signatures would be required of all these partners, especially if you talk about a CFM like that of us. If we are having 15 partners, for example, and if you want to open a bank account, then we'll have to move from pillar to post to all the 15 partners to get the signatures done. So the thing becomes very difficult. You will be encountering a lot of problems. So it is always better to mention in the LLP agreement itself that in the LLP agreement itself, who would be the partners who would be responsible for operating the bank account. So there may be n number of things that can be there. So mutual rights and duties, which is very much important part, this needs to be addressed in our LLP agreement. So the rights and duties between the partners per se, and as well as the LLP and the partners. So it's just like memorandum and articles of association of the company, I would say. So article of association for the internal management, same is the LLP agreement. Then again, it is not compulsory to enter into an LLP agreement. As I said, if you do not enter into an LLP agreement, then Schedule 1 would automatically be applicable, and whatever the mutual rights of partners in relation to LLP and everything will be decided as per Schedule 1. But friend, there is a practical challenge. We have to file Form 3 once the LLP is incorporated, and in Form 3 we have to attach that LLP agreement. So if the LLP agreement is not there, will not be filed to, will be able to file the LLP agreement, and thereafter there would be penalty of or additional fee of rupees, rather additional fee I would say 100 rupees per day for the day the default is continued. So it is always better to draft the LLP agreement in time and to file form number 3. Here this LLP agreement is to be filed subsequent of the incorporation. Form 1, 2, whatever it is there. After 2, form number 2, this LLP gets incorporated, and after incorporation we have to file within 30 days form number 3 for filing the various terms and conditions and everything, that is the LLP agreement. And on every subsequent modifications also, for example, after 2 years we induct some partner, or some partner is retired from the LLP, or if there is a change in the capital structure, or there may be any other change, so it can be done any point of time. So that time also for modification form number 3 is required to be filed. Then due to the different type of the nature of the various businesses, it may not be practically advisable to have those standard clauses as mentioned in Schedule 1 as I discussed. Therefore, it is very much advisable to have a legally drafted agreement and in sync with the nature of the business. So we must we must have detailed elaboration with our client. We should take the points and everything. We should give in our thoughts, and then thereafter we need to come out with a draft agreement. We should do the vetting first, and then we should discuss again, sit with the client, and we need to discuss with him that, see, these are the things that we have mentioned, and now if you feel okay, or if any other modifications are required, it is in the sync with the nature of the business, everything is perfect, then only we need to go and get it printed, and not otherwise till then. So what are these 13 clauses that are there in the LLP agreement, which we just discussed, the Schedule 1. So first one is the parties, individuals or body corporate, that is who would be the partner in the LLP. The next one is the object. What is the objective of the LLP? For what purpose we are creating this? Then the definition and interpretation clause. This is very general in nature, which is otherwise also there. Then the commencement of the business of LLP. Fifth one is duration of the LLP. Sixth is designated partners, LLP Act. working partner, it is being said right. Friends, here also again I would like to discuss with you. Friends, normally what happens, the designated partner, people treat it to be at par with the working partners. But it is not so. Designated partners are not the only working partners. It all depends upon LLP Act. In LLP Act, the word designated partners is used. At times, it is compared with the directors in case of company. In case of normal partnership firm, it is compared with the working partners. But let us very categorically understand that this is not the designated partner what is meant. In LLP Act, it is categorically defined what is designated partner. Designated partners are the partners who are responsible for the compliance of the LLP Act. So designated partners are nothing, they are not special, but the only thing is for any compliance of the LLP Act, designated partners will be the responsible partners. So even a non-designated partner may be a working partner, possible, and a designated partner may not be a working partner, possible. So what we need to, while drafting the LLP agreement, we need to address this particular point. How? We need to mention in the LLP agreement that A, B, C, and D are the partners in the company, in the LLP. Out of this, A and B would be designated partner and C and D would be the other partners. But at the same time, we can mention that C and B, C and D would be the working partners. So working partners with respect to Income Tax Act also, because if you want to claim that remuneration as an allowable expenditure, we need to mention that so and so are the working partners. So you may see a LLP agreement wherein they have mentioned about the designated partners, but they have not mentioned anything about the working partners. And tomorrow they say that these designated partners automatically means to be the working partners. So I doubt that that will not hold true, and the remuneration that has been given to designated partners may be disallowed, because the concept of working partner is very much different from that of designated partners. Nowhere it is mentioned that designated partners alone would be the working partners. So in our LLP agreement, we need to very categorically mention that apart from the designated partner, we need to also mention about the working partners. So friends, I hope that the difference between designated partner and working partner is clear over here, because designated partner is nothing but he's the only partner with the responsibility of the compliance of the LLP Act, nothing else. You may also put in your LLP agreement that Mr. A and B are the designated partner and C and D are the working partners, and the bank operation would be done by working partners, possible. Though he is a designated partner, but he would not be entitled to operate the bank account also, possible. So LLP agreement is the supreme document. That's why I say we need to be very much thoughtful while drafting the LLP agreement. Then role of the partners in management. As I said, that this again needs to be very clearly and categorically defined who would be playing the various roles, various duties. Otherwise there can be chaos, because all the partners would be getting involved. If there is an LLP with 100 partners, then there would be big chaos. Who would be doing what? Tomorrow, if all the partners come in to play active part in the management, then there may be problems. So it is always better you clearly and categorically define the role of the various and different partners in the management. Contribution, section 32, contribution of the partners. This contribution can be in cash or it may be in kind. We need to again mention that what is the amount that is agreed to be contributed by each of the partner, because the liability of the partner would be limited to the amount he or she agrees to contribute. So, and it can be in cash, it can be in kind. Even there may be situation in this contribution can be in lieu of the services that one would be providing to the LLP. Then partners, various rights, various duties, and whatever, all these also needs to be mentioned. Define the share in the capital in the profit and loss account. So friends, this is again very important. We need to mention what if the total amount agreed to be contributed of the LLPs, for example, 10 lakh rupees, and if individually it is not mentioned about those four partners, that is A, B, and C and D. Actually, it was agreed upon between them that A would be, for example, paying 5 lakh rupees, B would be paying, for example, 3 lakh rupees, and C and D would be contributing 1 lakh each, so total 10 lakh rupees. But it has not been mentioned in the LLP agreement, then they would all be equally responsible for this. So the liability for each of them would be 2.5 lakhs each. But whereas actually it was intended that A would be contributing the 50% of the capital, that is 5 lakh, B would be 3 lakhs, and C and D would be 1 lakh each. So here also we need to mention very categorically then which partner would be contributing what. And then profit and loss, this also needs to be clearly mentioned, what would be the profit sharing ratio. In absence of this, what will happen? For example, if we continue with the earlier example 5, 3, 1 and 1, suppose actually the contribution has been made by A, B, C and D in the ratio of 5:3:1:1, that is 5 lakh, 3 lakh, 1 lakh and 1 lakh, but nothing has been mentioned with regards to profit and losses, then the profit sharing would be done in equal proportion and not 5:3:1:1. So actually, though the amount contributed by A is 5 lakh rupees, but still C and D would be entitled to the profits of 25% each. So then there would be again a problem. So this also needs to be categorically mentioned. The profit sharing ratio is to be mentioned. The capital sharing ratio is to be mentioned in the LLP agreement. Otherwise, this will lead to disputes in future. Then just now we discussed, while discussing this designated partners and working partners. So remuneration to the working partners needs to be mentioned separately. That is what amount we would be paying. Undoubtedly, section 40B, disallowance under IT Act, Income Tax Act, this needs to be taken care of. So within the overall limit that are provided in the Income Tax Act, we need to provide that. Then they define the interest to the partners, maximum 12%. This we have been doing for years in case of traditional partnership firms, this remuneration and interest. So I would not discuss much on this, but the only thing is whatever that is applicable to a traditional partnership firm, same is applicable to a limited liability partnership. So the only difference is, as I say, we need to be very categorical while giving the remuneration to the working partners, because many times I've seen people mention designated partner and they think that the matter is over, no need to mention about working partners. They treat designated partners to be the working partners, and there becomes the problem. So we need to take care of that. Always mention remuneration to the working partners very categorically and separately. Then last one, but not the least one, power to expel. This also needs to be mentioned or addressed in our LLP agreement, that under what situations, under what conditions any partner can be expelled from the LLP. If this is not mentioned, then things would be very difficult tomorrow if some person is acting against the interest of the LLP, or he is creating nuisance and the business cannot be run with he being there in the firm. And if he wants to expel, even if all the partners wish to expel him from the LLP, the things would be real difficult. But whereas if it is mentioned in the LLP agreement itself, assuming the various or anticipating the various kind of situations that may come up, under what situations one partner may be expelled or any partner may be expelled from the LLP, then again that would be great, and that must be addressed in our LLP agreement. So because of all these parameters and points, LLP agreement becomes an essential and vital piece. This is the lifeline of any LLP, I would say, and this needs to be drafted wisely. Next slide is all about the comparative analysis. Why LLP is to be set up? Why not any other partnership firm, or why not a company? Friends, so I have charted out some criteria or parameters based on which we would be discussing the pros and cons of the partnership firms, companies and LLPs. We'll compare each of these. Governing law, if we talk about, we all are aware of that in case of partnership firms, the partnerships are governed by the Partnership Act 1932, whereas the companies are governed by the Companies Act 2013. Earlier it was 1956, and the LLP Act. LLPs are governed by the LLP Act 2008 and the various rules that have been made under thereunder. Then registration. In case of partnership firm, we all understand that the registration of the partnership firm is optional. It is not compulsory at all. Whereas in case of company or in case of LLP, they come into very existence only because of the registration. Until unless a company or an LLP is registered, there is actually no existence of the LLP or the company. So registration with the ROC is must for both company as well as for the LLP. However, in case of partnership, the registration with the registrar of partnership firms, this is the registrar of firms, is optional. It is not compulsory. Though having been registered is having its own importance and own benefits. Creation. Partnership firm is created merely by a contract between the partners, whereas a company or a LLP is always created by law. Law, as we discussed, in case of LLP it is LLP Act, in case of company it is Companies Act. Distinct entity. So friends, partnership firm, it is not a separate legal entity. It is merely the bunch of the partners put together. It is nothing but the common interest of the few individuals which is being represented. So it is not a separate legal entity. It is just a bundle of people working together, I would say. In case of company, it is always a separate legal entity under the Companies Act 2013, and same is the case with LLP. LLP is always a separate legal entity under the LLP Act. It continues, or its existence, or its entity, its separate legal entity is a distinct entity, and it's different from its partners or the members of the company. So all the partners tomorrow may come in, may go out, but the LLP will not have any impact because it's a separate legal entity and it can hold properties in its own name. It can enter into various contexts and everything, whereas the traditional partnership firm cannot do so. Choice of name. In case of partnership firms, we all know nobody stops us, though there is a Trademark Act is there, IPR, so we need to take care of that. But even if you create any name, though it will be infringement of some trademark, but nobody comes to you until unless that owner of the trademark that complains somewhere, he comes to know about your firm or company or anything and he complains, then there is a problem. But otherwise, nobody virtually stops you from adopting any name in case of a partnership firm. But in case of company and in case of LLP, the name can only is subject to approval by the ROC. You'll have to select a name for your firm or for your LLP or a company, and then you'll have to apply, and subsequently if it is approved, then only you can have that name. So trademark is always taken care of by the registrar. Then cost of formation. In case of partnership firm, we generally understand there is very, very low cost, no cost as such. And these days, so now the company maybe is bit higher in comparison to partnership firm, but as such, not much cost is involved in case of company or even in case of LLP. And perpetual succession, we have already discussed that irrespective of the number of partners, all the partners may come and go, but the LLP will continue because it is a perpetual succession, and all the partners, maybe there are 4 partners and all 4 partners may retire, and in case of 4, some new partners may come in, but still that will continue. In case of a company, same is the case. All the members may change, all the shareholders may change their hands, may transfer their shares to new shareholders, and still that company would be having a perpetual succession, would be continuing. But in case of partnership firm, it does not have the perpetual succession, as this depends absolutely upon the will of the partners. Charter document we have discussed. In case of partnership firm, partnership deed is the charter document. In case of company, it is the memorandum and articles of association. That is the charter of the company, and which define its scope of operations. Whereas in case of an LLP agreement is the charter of the LLP, which denotes its scope of operations and rights and duties of the partners vis-a-vis LLP. Common seal. Friends, in case of partnership, there is no concept of common seal at all. However, in case of a company, in Companies Act 1956, the common seal was very much compulsory. But thereafter, with this Companies Act 2013, they have made it optional. Now it is not necessary or compulsory to have a common seal for the company. It is absolutely up to the company that it wants to have one or not. Whereas in case of LLP also, it doesn't have any compulsion to have its common seal. It is again optional with them. Though it denotes the signature, and LLP may have its own common seal, but it is not necessarily at all in case of company and LLP. Now it is not necessary. Earlier it was in case of company. Formalities of incorporation also, again, if we talk about the partnership form, we all understand it is very much simple to incorporate a partnership form or to create a partnership firm, I would say, because only what you need to do is you need to simply draft a partnership agreement and execute it. That's it. But whereas in case of companies and LLP, there is a SAT process which has to be followed. The digital signatures are to be obtained, the DIN numbers are required, and then various filing in the e-forms and everything has to be done on the MCA platform. And thereafter, after completion of all the formalities, this would be incorporated. So since partnership firm, as I said, is nothing but you need to simply execute the partnership agreement. So the time taken is very much nominal, whereas in case of companies and LLPs, it varies. From time to time, there may be different time frame, but as of now, if we talk about, then 7 to 8 days are normally required to create a LLP or a company. Legal proceedings. So partnership firms, if it is not registered, it doesn't have the authority of suing anybody. So only and only the registered partnerships can sue third parties. However, even if the partnership firm is not registered, the other can sue the partnership firm, but the partnership firm itself cannot sue others. So that is the problem if you are not registered. So even if there is a partnership firm, it is always advisable to register them with the registrar of firms. And if you talk about company and LP, both being a legal entity, separate legal entity, they always are entitled to sue others. They can sue and they can be sued. Foreign participation, this we'll discuss separately as well, but foreign nationals cannot be partner in a partnership firm. That we need to be very clear of. And in case of company, yes, foreign national can be a member in a company. And in case of LLP also, foreign nationals can be a partner in LLP. Also, we need to understand that in case of company, minimum one director must be resident in India. Out of total 2 directors that are required, minimum 2 directors are required in case of a company. Out of 2 directors, 1 must be resident in India. Resident in India means he must be minimum 182 days or more in India. And same is the case with LLP. In LLP also, out of 2, minimum 1 must be resident in India, and resident in India means he must be in India for 182 days or more in a year. Earlier, in case of companies, there was no such requirement of director being resident in India, but subsequently a modification was done and in Companies Act 2013. Now it is mandatory to have a director resident in India. Then number of members. Friends, in case of partnership firm, minimum is 2 and maximum it can be 50 members. Whereas in case of a company, in case of private companies, minimum is 2 but maximum can be 200 members in case of private company. And in case of a limited companies, it is minimum 7 members. Public limited company minimum is 7 and maximum there is no limit. Same is the case with LLP. In LLP, minimum number of partners required is 2, whereas there is no cap on the maximum number of partners. We have incorporated LLP with partners more than 100 also. Ownership of the assets. Partners have the joint ownership of all the assets belonging to the partnership firm, because partnership firm is not a separate legal entity. So whatever the assets of the partners is a common hodgepodge and is a common assets of the partner, and that is being hold in the partnership firm. Then company is a separate legal entity, so its assets are the ownership of the company and not that of its members. Though indirectly members being the shareholders of the company, they are the ultimate beneficial owners of the assets, but if they are not the direct owners, they are only, their entitlement is only up to the shares that they do hold. In case of LLP, again, LLP being independent of its member has the ownership of the assets, rights, duties, obligations of the partners and managing directors, etc. In case of partnership firms, the rights, duties, obligations of the partners are governed by partnership deed. Whereas in case of a company, rights, duties, obligation of the directors are governed by the article of association. There is a document which is there for the internal management of the company, and the resolution, various resolutions time to time which are passed by the shareholders of the directors. There is the resolutions in the general meeting or maybe in the board meeting. Then LLP also rights, duties and obligations of the partners are governed by the LLP agreement, as we discussed that yes, whatever rights, duties or obligations that are to be created or casted upon needs to be very well thought and needs to be incorporated in the LLP agreement. Liability of the partners or members. In case of partnership firms, friends, the liability of the partners is unlimited, and the partners are severally and jointly liable for the actions of other partners as well as the actions of the firms, and their liability extends to their personal assets as well. Whereas in case of a company, the liability of the shareholder is always limited to the amount of the share paid up on each single share. For example, if one is holding, X is holding 1 lakh shares, then at the rate of 10, so 10 lakh is the amount that he has paid towards paid up share capital. So his liability would be limited to 10 lakh rupees and not beyond that. Whereas the director's liability is also limited to that extent generally, but yes, there may be cases where there is an unlimited liability of the directors. But for the shareholders who are the real owners of the company, the liability is always limited to the amount that they have invested in the share capital. Whereas in a case of LLP, the liability is limited to the extent their contribution towards LLP, except in case of the intentional frauds or some wrongful act of omission or commission is there by the partner or partners, then yes, their liability may be undoubtedly unlimited, but otherwise in general circumstances, the liability of the partners would be limited to the amount agreed to be contributed. So when I use the word amount agreed to be contributed, it doesn't mean the actual amount contributed. It means the amount that they have agreed to contribute. For example, if in the partnership agreement it is said that they agreed to contribute 10 lakh rupees, but wherein actually they have contributed 6 lakh rupees, still the liability would be limited to 10 lakh rupees and not 6 lakhs, because what they have agreed to contribute is 10 lakh, though they might have contributed 6, or they need to bring in any point of time. So whatever amount that they have agreed to contribute, their liability would be restricted to that amount. Then tax liability, we'll discuss separately on this, but in case of partnership firms, we all are aware of that the tax rate is flat 30% plus education cess is there. In case of company, now after various amendments, the tax rates are much lower in case of companies, whereas in case of LLP is also taxed same way with that of partnership firm. There is no difference in taxability of partnership firm as well as LLP, because it is very clearly mentioned in the Income Tax Act that for all practical purpose, the taxation purpose, the LLP would be treated as a firm. So a firm includes an LLP. So LLP is nothing but an extended version of firm only. So LLP would be treated as a firm mutandis mutandis without any changes. There is only one change which is there in the entire Income Tax Act, where a firm is differentiated from an LLP. And where it is, friends, do you know? Friends, Section 44AD, presumptive taxation, if we talk about it, it is defined eligible SSC. So in 44AD, they have very categorically mentioned that eligible SSC includes an individual, an HUF, and a firm, but it does not include LLP. So specific exclusion with regards to LLP has been inserted in 44AD. So now because of this, the LLP cannot follow the concept of presumptive taxation. 44 AD in LLP is not eligible. So this is its own advantage and disadvantages. Suppose the firm is not covered under LLP is not covered under tax audit, and having a 20 lakh rupees maybe its turnover. So in other cases, because of the presumptive taxation, whatever it is 8% or 5%, you have mentioned the show the net profit, declare the net profit, else you'll have to undergo audit. But in case of LLP, it is even if the actual profit is maybe 2% or there may be a loss, and still the LLP will not be required to undergo any audit because it is not covered under 44 AD. So it may have any other amount of income, whatever it is, or maybe loss, and still not required to undergo audit. So whatsoever amount that is may be more or less, they can show. This is very important. Section 26 that deals with the principal and agent relationship. Friends, in case of partnership firm, the partners are the agent of the firm as well as they are agent of the other partners. Whereas in case of a company, members are not the agent of other members. And whereas in case of LLP, if we talk about, partners act as an agent of LLP and not that of the other partners. So what does it mean basically? When we say that a partner is the agent of the LLP and not of the other, or whereas when we say his partner is the agent of the firm as well as other partners, so there is a big difference. So when we say that partners are agent of the firm and other partners, it means all the partners are responsible for the act of each other. For example, A, B, C, and D are the 4 partners. If A does something wrong, so D is also responsible in that because he is the agent of the other partner. Whereas if we talk about LLP, since one partner is not the agent of the other partner, so only the person who has done something wrong, he would be responsible and not the other partner. And that is the reason that many chartered accountant firms these days have started converting their firm into an LLP. And almost all the big firms have already converted their firm into an LLP. And the other firms also, because you never know, you are sitting in maybe Mumbai and some other partner sitting in Delhi, what he is doing, if there is anything, and you may tomorrow be held responsible for his act or his negligence. So there will be a situation. So it is always better to have a LLP than the partnership, traditional partnership firm. This is an edge over the partnership firms. So there are various things like, as we discussed, separate legal existence is there, or separate legal entity is there, then perpetual succession is there, agency relationship, which again is very important, tax liabilities. So all these things are there. So people always should prefer LLP over the partnership firm. Then transfer of shares in case of partnership firm, the share is not transferable. At the most, one can take a retirement by offering his resignation. In case of a company, ownership is easily transferable by way of transfer of shares. In case of LLP, regulation relating to transfers are governed by the LLP agreement. Again, this needs to be mentioned in the LLP agreement. How and under what situation one partner may transfer his share of profit or capital to another person, or how he can retire and how another person can be elected in his place. All these things needs to be addressed in the LLP agreement. As we discussed, in case of company, it is easily transferable. You may sell your shares, you may transfer them. Even if there is a death of the original shareholder, there will be a transmission of the shares. All these things is possible. Such transmission is also not possible in the case of LLP. This also needs to be clearly provided in the LLP agreement. The only thing is the shares, the amount which is entitled to a deceased partner will be given to the legal heir. But here, if something on the contrary is provided in the LLP agreement, yes, that will be taken care of. Automatic inclusion of other person in place of the old one will not happen. Then, in case of dissolution, in case of partnership firm, by agreement or mutual consent or insolvency or certain other contingencies, or maybe by court order, this dissolution may happen. Whereas in case of company, it may be voluntary or by order of NCLT, or maybe by ROC under section 248 of the Companies Act. It is possible. In case of LLP closure may again be a voluntary closure or by the order of the NCLT or maybe by ROC. Admission as partner or member. A person can be admitted as a partner as per the partnership agreement. Same is the case in LLP, as we mentioned or as we discussed, that a person can be admitted as a partner in LLP only as per the LLP agreement and not otherwise. Whereas in case of a company, a person can become a member simply by buying the shares of that company. If he owns the shares, he can be the member of the company. Cessation as a partner or member. A person ceases to be a partner maybe by resignation or due to death or as per the agreement. Whereas in case of a company, a member or a shareholder can cease to be a member only and only by transferring his shares. In case of LLP, a person ceases to be a partner as per the LLP agreement or in the absence of the same. If nothing is mentioned in the LLP agreement, still he can resign from the LLP by giving a 30 days prior notice to the LLP. If such notice is given, so mind well, it is always better to be mentioned in the LLP agreement, but if in any case it is not possible to mention the LLP agreement, then you need to give 30 days clear-cut notice. So friends, even if there may be some agreement that has already been drafted, we always need to just go and check once, and we need to do the wettings of the LLP agreement. And if there are some deficiencies or lacunae are there, this needs to be removed, especially few with regards to that of like roles and responsibilities of the partners, mutual this, and especially the working remuneration to the working partners. This needs to be addressed very categorically. Then the next important thing is statutory meeting. In case of partnership, there is no such provision with regard to holding of any such meetings, whereas in case of company, we all understand that minimum 4 board meetings in a year, 1 general meeting in a year. These are compulsory and this requires to be conducted at an appropriate interval. Whereas in case of LLP, there is no provision with regard to holding of any meeting in the case of LLP. Whereas, though I would always suggest that it is better, since this is a body corporate, it is always better to maintain a registered minutes, and we should always record the decisions that are taken amongst the partners. Maybe there is no requirement as such of meeting, but the partners always used to meet, they used to take the decisions jointly and whatever. So we always should develop a practice of minutizing the facts, because tomorrow if something goes wrong, if there are any dispute or some problems come up in the LLP, then such kind of minutes which are signed by all the partners can come to rescue. Because subsequently after 5 years, if you ask your partners who are creating the dispute to sign in the minutes book, it will not be signed, nobody would sign. But if as a concurrent practice, if it can be developed, and if whatever discussions or decisions that has been taken by the LLP on behalf, or by the partners on behalf of the LLP in the meeting, may it be telephonic meeting, may it be audio visual meeting, or maybe video conferencing, or maybe actual meeting, whatever it is. So these things needs to be documented and try to get the signatures on all such meetings, have minutize such kind of meetings, and this would be of great help. This very few LLPs are doing, those who are having very healthy practices, they people are maintaining the minutes, but most of the LLPs are otherwise not maintaining any kind of minutes. So tomorrow if somebody challenges why and on what grounds such a decision was taken, then we won't be having any answer. So it is always better to minutize the discussions. Annual filing. In case of partnership firm, no return is required to be filed with registrar of firms. Whereas in case of companies, we all understand that yes, the annual financial statements and annual return in MGTs, this AOC 4 and MGT 7, these are required to be filed with ROC every year. Then in case of LLP also, again, statement of accounts and solvency needs to be filed in form number 8 and form number 11 every year with ROC. So friends, this filing is to be done. This form number 11, which is the annual return, this needs to be filed within 60 days from the end of the financial year. So 31st March is the end of the financial year. So 60th day is 30th May. So this return needs to be filed on and before 30th of May. So not 31st May. Normally we see the last month of the last day of the month, that is 31st May? No, it should be within 30th of May, 60 days. So after, if you go beyond that, then there would be delay and 100 rupees per day. So 100 rupees is not the question here, but its question is about the compliance and meeting the deadlines. Same in case of Form 8, this needs to be filed within 30 days of the end of 6 months. So 30 days of the end of the 6 months from the financial year. So financial year ending on 31st of March, 6 months is 30th September. 30 days from 30th September is 30th October and not 31st of October. So 30th October is the last day for filing of this. Even if there are some default, there is some delay in filing of the Form 8 and 11, these are pending. Friends, the LLP settlement scheme is in continuance, which has been effective from 1st of April, and no additional fee of 100 rupees per day would be levied. So please take care, complete the filings before 31st of August, though the scheme is in continuance till 30th of September. But on plain reading of the scheme, it goes like, if we file the document after 31st of August, there will be no additional fee. But if we file after 31st of August, but before 30th of September, then there will be additional fee, but no prosecution or no action will be taken against the LLP. So action is one part and additional fee is another part. So it is always better we file before 31st of August. So both immunity as well as additional fee, both we can get the benefit of. So please just check all your LLPs wheresoever, and even in case of companies also, CFSS is going on. So company first tax scheme. So if any filing is pending with regards to AOC 4 or MGT 7, and in case, especially in case of LLP, if some Form 3 or 4 or such form is pending, that also needs to be taken care of. If any agreement wherein maybe the initial agreement, or if there are subsequent modifications of the agreement, these are yet to be filed, or if this is pending for any reason, I would suggest, I would request, please file those forms, because these are also covered under the scheme and the additional fee will not be levied in such form. So whatever filing that is you think is pending, just have a review first and then you can complete the filings. Then the next part is audit of the accounts. Friends, when the word audit comes, yes, we all feel happy. Here, partnership firms are only required to have the tax audit. There is no other statutory requirement of any other audit under any other statute. But the partnership firm needs to get their accounts audited only if the turnover surpasses the amount that has been prescribed in the Income Tax Act. So if the ceiling of the Income Tax Act that is reached, then and then only audit of accounts is required under the Income Tax Act for the partnership firm, or else under the presumptive taxation, that is 44 AB, EU or F, the audit may be required and not otherwise. However, in case of company, irrespective of the turnover or irrespective of the capital, irrespective of whether it is a private company or it is a public company, compulsorily audit will have to be done. Whereas in case of LLP, friends, LLP we need to be very clear that there are two scenarios wherein there can be audit. First scenario is as per the Act and rules. The Rule 24 of the LLP Act, under the LLP Act, provides that if the turnover exceeds 40 lakhs, mind well friends, exceeds, even if it is 40 lakhs, audit is not required under LLP Act. But if the turnover exceeds 40 lakhs, then the audit would be required, or else maybe the turnover is not exceeding, but the contribution that exceeds 25 lakh rupees. In such scenario, the accounts of that particular financial year needs to be audited. So friends, if the turnover exceeds 40 or the contribution exceeds 25 lakh rupees, in such case the account needs to be audited under the LLP Act. However, for so far as the income tax is concerned, the limits of the Income Tax Act would be applicable, and that is 1 crore, 2 crore, whatever it is. Based on that, the LLP would be audited. So friends, this audit is to be done under LLP Act, 40 lakh rupees and 25 lakh rupees. And there is no specific format, no audit report formats that are mentioned for the LLP. So normally we follow the format that are applicable to the companies. Those formats we normally follow for doing the audit report of the LLPs as well. One more thing with regards to accounts. The partnership firm can have their accounts both on cash as well as mercantile basis. Whereas in case of company, it has to be compulsory on mercantile basis, accrual basis the only basis. In LLP also, there is no restriction. We can mention the accounts both in accrual as well as on cash basis account. Then the last comparison is on account of the peace employee. Friends, in case of partnership firm, no such provision is there under the Partnership Act 1932 of the official drawing. Whereas in case of companies, earlier there was no such provision, but with the advent of this Companies Act 2013, the listed companies and such class of companies which has been prescribed are mandatory to follow the provisions of the official drawing. Whereas in the case of LLP, provision has been made to provide for the protection to those employees and partners who provides useful information during an investigation or convicting any partner or firm. So if any employee, it is applicable to employees as well as any partner who comes forward and shares some information to the LLP, even during some investigations or maybe even before that, and then that whistleblower is immune, is protected from further actions. Yeah. So now this the second aspect, that is the procedural aspect, that I will not like to discuss much in detail, but would like to share some basic information on it. That's it. First step of registering an LLP is to reserve the name through the RUN LLP. That's the registered unique number. It is being said as RUN, RUN, register unique name. So once unique name is registered for the LLP, you file this and approved. The name is approved. Subsequently, you need to file the incorporation documents in the form fill-up. Earlier it used to be form 2, but now it is form fill-up. So in form fill-up, one thing is that is form 9 is to be attached. That is the physical form, consent to act as a designated partner. Then subscriber sheet is to be there. Registered address, LLP registered address, that proof is to be given. Then NOC, if from the owner of that particular place, which is the registered office which is owned by somebody, so NOC of the owner is required. Then a PAN card of all the partners, and the proof of identity proof is required. And this can be either of three, there is a passport, driving license, or voter ID card of all the partners, including designated partners. Proof of address is required, and address proof again can be these three documents only. That is the bank passbook that can be there, or this. So nothing else. Then comes once this is done, once the filing is done, then the name would be approved. And once the name is approved, so sorry, the proof of address we discussed. One is bank passbook, then electricity bill or mobile bill. These three documents can be there. So once this is done, and thereafter LLP, once this is approved, fill-up form is approved, LLP is incorporated. Once the LLP is incorporated, within next 30 days, you have to file the summary of the LLP agreement, as well as you have to attach the LLP agreement in that form number 3. And you have to file this as per rule 21 for this. So this has to be executed, stamp duty is to be paid. So what is the stamp duty on such agreement? Friends, stamp is a state subject and it varies from state to state. In most of the states, however, the stamp duty is just like the same, which is applicable to the traditional partnership firm. So rupees, for example, if you talk about Gujarat, in Gujarat it is 1 rupees per 100, maximum 10,000 rupees. That is what the stamp duty is. So for example, 1 lakh is the capital for the LLP, then 1,000 would be the stamp duty. And if it is 10 lakh rupees capital, then it will be 10,000. If 20 lakh rupees is the capital, then again it will be 10,000, because 10,000 is the maximum limit that has been prescribed. These are the various forms that are there on the applicable to LLPs. This includes RUN LLP, that is for the name reservation, register unique name. Then the incorporation, earlier it was form 2, now it is fill-up form is there. Information with regards to The agreement, there is form number 3. Notice of appointment, cessation, change in name, address of the individual partners, designated partners, and all this. This form number 4. Notice for change of name, form number 5. Then application for allotment of designated partner. Now obviously there is no concept of DPIN. Earlier it used to be designated partner identification number. Thereafter it was made same for both director as well as for designated partner. So now we have to file DIR 3. Then statement of accounts and solvency, then intimation of changes in particulars by the designated partners in form number 10. Various other forms like form number 11, form number 12. There is 12 is for intimating other address. See, this is again a beautiful concept in case of LLP. Form number 12 that I would like to discuss here. Friends, here form number 12, which provides for intimating other address for service of documents. Normally we know that in case of a company there is a registered office. So if any documents are to be addressed or signed, compulsorily it has to go to the registered office of the company. Many times we call it corporate office, registered office, all these words, but as such formally there is no concept of corporate office. For every purpose of the Companies Act, a registered office has to be there and the documents will be served on that address only. Whereas in case of LLP, there is a possibility that your registered office maybe is in a, for example, remote place, and your corporate office is in the city of Mumbai, and you wish that the documents be served where the directors of, I would say the designated partners and the partners normally sits in the corporate office in Mumbai, and if you wish that the documents be served at that office, then you can always file this form 12 and you can mention this as your other address, and any documents that is being sent by ROC for LLP or by any other person, any other organization can also be sent, or any other authority as well can be sent on this other address that has been mentioned by way of form 12. So this is a beautiful concept which is not available otherwise in other forms of carrying of business. Then form number 15 is notice of change of place of registered office. If you are changing the registered office from one place to another, then yes, form number 15 is there. Then 17 and 18, these are with respect to conversion, and 22 is okay. Then application for direction to see, again this is there. If you have an LLP name which is in conflict with some other organization because of the trademark or some other reasons, then the other party may also file for change of name. They may request. It is not so that you only yourself, the LLP yourself itself goes and says that we want to change our name. There may be application by the third party to the registrar and for issuing the direction to change the name of the LLP. This is also possible. Then form 24 is application to the registrar for striking off of the name of the company. See, for example, if the LLP is no more into action, and if you wish to close down the LLP to get the name striked off, then we need to file in form number 24 for striking off of the company. Then next is application for reservation, and this it's fine, okay. Renewal of name by foreign LLP and foreign company. In case of foreign company or foreign LLP, for to have a place of business in India, they can file form number 25. And then form for registration of particulars by foreign LLP is form number 27. Then alteration in the incorporation document or other instrument constituting or defining the constitution of a LLP incorporated or registered outside India, or in the case of a registered or principal office of a LLP, form number 28 is to be filed. And if there is alteration in certificate of incorporation or registration of LLP incorporated or registered outside India, or alteration in the name or address of any of the person authorized to accept service on behalf of a foreign such company LLP, then form number 29 is to be filed. And application for compounding of the offences under the Act, form number 31 is there. Now let us discuss in detail about accounts and solvency and as well as audit. Friends, while comparing the three different alternates, of carrying out business, that is partnership firm, company and LLP. Though we have discussed everything on this, but still I would like to go through it once. If something is left, then we can discuss over here. One is LLP is required to maintain its books of accounts for each year as prescribed by law. So every year we have to maintain the books of accounts. That is a compulsion. The only thing is these books can be maintained both on cash basis as well as on accrual basis, but compulsorily it has to be under double entry system. It cannot be a single entry system. The system needs to be double entry. However, it may be cash or on accrual basis, because various like professional firms like that of CA, they would be maintaining this on cash basis system. Then books of accounts to be maintained for 8 years from the date on which they are made. So what the line that has been used in the act is from the day on which they are, from the date on which they are made. So ideally would normally be the year to which it relates. It would be like that only. So 8 years from there. Every designated partner shall have deemed to approve the accounts unless one take all reasonable steps to prevent their being approved and signed. So when I discussed about the minutes of the meeting, here again it is important. There may be some accounts of the LLP, and if one of the partner or designated partner, especially since the compliance of the act is the responsibility of the designated partner, so here especially the designated partner, if they do not take any reasonable step to get them prevented from being approved, then yes, they would be responsible even if there is something wrong in the accounts. So they must take all steps to see before the approval of the accounts that yes, the accounts are correct in all ways and means. So they must check those accounts, they should be there, and if there is anything wrong, then yes, they must raise their voice, they must get the dissent recorded. That will be of great help to them. If the dissent is not recorded and if the accounts are approved without any dissent from their side, from the designated partner side, then in tomorrow's if any something comes up, then they will be in a problem. Then this form number 8 and 11, this we have already discussed, that yes, form number 8 needs to be filed within 60 days, and this form number 8 needs to be filed within 6 months, 30 days at the end of the 6 months, and form number 11, which is annual return, this needs to be filed within 38 before the 30 days. Form 8 needs to be filed within 30 days of the 6 months of the end of the financial year, and form 11, which is the annual return, that needs to be filed within 60 days of the end of the financial year. So this is again important. If there is any default in the compliance, then there are, apart from the additional fee, there may be penalty also. So every LLP to file annual return within 60 days of closure of the financial year. In case of the failure to do such under section 35, the designated partner to be fined with rupees 10,000, which can extend up to rupees 1 lakh rupees each of the designated partner, and additional fee we understand that is always there of rupees 100 per day. And account shall be audited by the auditors appointed by the LLP in accordance with Rule 24. Audit is compulsory if the turnover exceeds 40 lakhs and contribution exceeds 25 lakhs. This we have already discussed. Then one more thing here which I missed. So though it is a statutory requirement of the LLP Act that if the turnover exceeds 40 lakhs and the contribution exceeds 25 lakhs, then and then only the audit for the LLP is required. But friends, if in the LLP agreement, if it is mentioned that irrespective of the turnover, the accounts of the, or irrespective of the contribution by the partners, the accounts of the LLP needs to be audited every year. So then it becomes compulsory. So while discussing with the promoters of the LLP, if we can convince them that yes, this will always be a value addition if the CA can verify your accounts, if they can check the accounts, if they are audited. So yes, if it is mentioned in the LLP agreement, then this limit of 40 lakhs or 25 lakhs will go away, because the LLP agreement is a supreme document, it is a charter document. So in that case, the audit limit of 40 or 25 will not apply, and it will be compulsory to carry out the audit even if it is turnover is rupees 1 only. And when the auditor is to be appointed, the auditor shall be appointed before the end of the first of the financial year for first year. So if LLP is incorporated, for example, say on 30th of September 2019, then before 31st of March 2020, the auditor needs to be appointed. whereas the subsequent auditors are to be appointed before the 30 days of the end of the next financial year. And if any auditor he wants to resign by giving, then he can do so, but he needs to give a notice of at least 14 days, and that too prior to the last date of appointment of auditor. So here, since the auditor needs to be appointed before 30 days of the end of the financial year, so for example, if it is a subsequent year, then the auditor needs to be appointed for financial year, then for year ending on 31st March 20, he should ideally be appointed by 1st of March, because 30 days. So 1st of March, from here we should minus 14 days, and whatsoever date that it comes, like maybe you can say 14th of February. So by 14th of February he needs to resign. After that he cannot resign. So that we needs to check. So auditor can resign by giving a notice 14 days prior to the last date for the appointment of auditor. So in case of first year, it is before the end of the first year. In case for the next subsequent years, is 30 days before the end of the financial year. This needs to be done. Otherwise, if this resignation is not done in time, then the resignation will not be treated as effective. And auditor terms comes to an end on deposit of notice for retirement or resignation, or the date mentioned therein. For example, if you submit the notice on 10th of February and you say that after this particular audit for the current year of the year 2021, I will not, for the audit of 1920, I will not serve as the auditor. So this will be applicable from that date that is mentioned in the resignation letter. As such, in case if the turnover of the LLP exceeds rupees 5 crore, or if the contribution exceeds rupees 50 lakh, then the annual return, there is a form number 11 of the LLP, needs to be certified by a practicing company secretary. Just like in case of a companies, there is a requirement. Same here, it is mentioned that yes, in case of turnover, if it exceeds 5 crore, or contribution if it exceeds 50 lakhs, then the compulsory certification of a company secretary, practicing company secretary, is required. Friends, this was all about the LLP portion per se. Now we would be dealing with the conversion to LLP, and thereafter, after conversion, we'll get into the taxation of the LLPs. These are the two different, the two other agendas that are pending. Now, conversion as such, I will not discuss about the procedural aspect. I'd like to only discuss on the key points with regards to conversion. Friends, the entire mechanism of conversion in case of LLP is dealt with by section 55, 56 and 57. All these sections are absolutely same except for the change, the word that is used as partnership firm, private company or a limited company. There is a conversion of a private company to LLP, or a company, or conversion of a partnership firm to LLP, or conversion of a unlisted public company to a LLP. So these 55, 56 and 57 and schedule 2, 3 and 4, these are the schedules which deal with the conversion. So schedule 55 plus section 55 plus schedule 2, this deals with conversion of a partnership firm into a LLP. Schedule 3 and section 56 deals with a private company, and schedule 4 and section 57 deals with public unlisted company. So most of the things would be same except for enabling the firm, company or a private company or a limited company. So first thing is eligibility. What is eligibility? Which firm? As per section 55, since it deals with firm, so which firm? A firm can be converted only if all the partners agree to become the partners of LLP. So first and foremost condition is all the partners must agree. Hello. Hello. Yeah. Sorry. So first and foremost condition is a firm can be converted only if all the partners agree to become partners of LLP. So in case of section 56, that is, and schedule 3, which deals with the conversion of a private company into LLP, the only thing is, in place of partners, it is mentioned is all the shareholders must agree to become partners of LLP. In case of partnership, since there are no shareholders but the partners of the firm, so it is mentioned all the partners must agree. In case of section 56 or section 57, it is mentioned all the members must agree. So now, what if in case of a firm, if all the partners doesn't agree, can we convert it to a LLP? Ideally, no. But yes, what we need to do is either we need to ask that partner who is not willing to get converted the firm into LLP to resign from the partnership firm. Once the person resigns, and with all the consenting partners, you can very well convert. Same way in case of a company, if any particular shareholder, if he is not ready to get converted into LLP, the other shareholders can always sit with him, can convince him, and whatever the dues that are payable to him, if he considers your this request, and if the shares can be transferred of the dissenting shareholder, and if he agrees to take his own share or amount, and then subsequently goes away with the remaining shareholders, the consenting shareholders, yes, the conversion can very well happen. Then the first and foremost condition is all must agree, and the next condition is there must be no security interest subsisting, like that of maybe mortgage. So ideally there should be no secured loan that is there in case of a private company, or this schedule 3 it is mentioned, even in schedule 4 also. Then if these two conditions are satisfied, then there is absolutely no problem. If there is such security interest is subsisting, then what you need to do is you need to first make the payment of that loan, remove the charge, satisfy the charge, and then yes, obviously you can go for the conversion, not otherwise. However, as per section 366 of the Companies Act, if the joint stock companies, the conversion of a partnership firm into a company, therein it is possible. The only thing is you need to take a NOC from the secured creditors that sir, we want to convert our company, our LLP into a company. The probable reason may be because when you are going from this flexible organization to a more stricter design, because LLP is very comparatively very flexible, and if you are going to resign of companies, then there they are not restricting, they are simply saying that you just give us NOC. But when we are moving from a flexible, from a stricter design to a flexible design, that is from company to a LLP, then they have specifically they have barred. You cannot move from a company to a LLP if there is any security interest that is subsisting. Then next comes once the formalities that are there, if these are completed, means you have see, this can only be proceeded with conversion only and only if first you have minimum filed one your this returns, annual returns and statement of solvencies and accounts. You have completed all these annual returns and statements. The other thing is you must have filed your income tax returns and everything. So all these things formalities are completed, and thereafter latest statement, financial statement should be prepared. This should be certified by a chartered accountant, and this should be filed, and subsequently yes, so after completing all these formalities, you can convert your firm, private company, or unlisted public company into a LLP. Then once you have completed all the formality and registrar is satisfied with that, then registrar will issue a certificate in form number 19 for certificate of incorporation of that LLP, and registration, after registration of the LLP, erstwhile company or the erstwhile firm will be deemed to be dissolved, and the LLP will come into existence. So now, on incorporation of LLP, all the rights and the liabilities under various agreements that were executed by the firm or by the company, as the case may be, shall stand assigned to LLP as if those agreements were actually executed by the LLP. So what does it mean? That if there is any conversion that takes place, on conversion on the new LLP that is incorporated now because of the conversion, So the rights and liabilities of all the agreements which have been executed earlier will stand assigned to LLP as if the LLP itself entered into all those agreements. Then all the properties may be tangible, may be intangible, may be movable, may be immovable of the previous firm or company would vest in LLP without any further assurance, act or deed. So friends, if there is any property in the company or may be firm, all these properties will stand transferred and would vest in LLP without any further act, assurance or deed. But friends, then what would be the fate of the stamp duty? Suppose there is an LLP, there is a company wherein there is immovable property of 10 crore rupees, and on conversion, now the LLP comes into existence. So to get the name changed in the records of the sub-registrar, whether any stamp duty will have to be paid afresh. Friends, this being a central legislation and overriding in nature, ideally it should be not a single penny is to be paid, because they have clearly mentioned that without any further assurance, act or deed. And in case of joint stock companies, when we convert any partnership firm into company, we have seen for years altogether that no stamp duty is required to be paid. Only on giving that certificate and an application and the requisite form, the people would be transferring. But here there are some different things that are coming up. Recently in Rajasthan it has happened, not recently, I would say almost 2-3 years. In Rajasthan it has happened that the registrar have asked for stamp duty for transferring the name of such this. But if you talk about Gujarat, it is being done without anything. Simply you need to make an application and they people are enabling it. They don't ask for additional stamp duty. But the only thing is we need to go and convince the sub-registrar, we need to tell them, we need to satisfy them that how the things are being, or this is because of the effect of the conversion. The LLP is only not new entity, but it is only because the conversion of the first firm or a company or private company or a limited company, whatever it is. So ideally it should be without any stamp duty. No stamp duty needs to be paid, but friends, it depends state to state, and the practical experience that is there in every single state, we need to see that. But ideally, if we can cite this and we can share them, then yes, it should be done. Then if firm or company is registered with any authority, for example, small scale industries, MSME registration is there, or some other registration is there, it may be some GST registration is there, then LLP must notify the authorities like that of SSI or GST or any other about the conversion and submit the particulars in such form as the authority may specify. Even in case of income tax also, the PAN card will change because of the code, because in case of LLP it would be the fourth letter would be F, in case of company the fourth letter is C. So over there also you need to mention this. Then for a next period of 12 months, LLP will have to mention its previous name and registration number and the business form. Business form means whether it was carrying on earlier as a private company or as an unlisted public company or as a partnership firm. So this also needs to be mentioned for the next 12 months, and on all the letterheads, documents, signboards, wherever the name of LLP is to be mentioned, at all such places, its previous name and registration number and previous business form has to be mentioned for the next 12 years. So mind well friends, many conversions are taking place, but then people forget about this and they do not mention about this. So again, this needs to be taken care of, because this is a default. Otherwise huge penalties may be levied if some complaint is made and if somebody is able to prove that this condition is not being met with. If the registrar refuses the registration, the registrar of companies, if they refuses the registration for conversion of a company into LLP or a partnership firm into LLP, the applicant may apply to the tribunal. Tribunal means NCLT within 60 days from such intimation of refusal. Friends, one more thing, in case of this conversions, if it is a partnership firm and if you want to get it converted into LLP, then this partnership firm has to register first. So registration is compulsory, one thing. And in case of partnership firms, this until unless we do the registration, they'll not allow us to convert into LLP. And the other thing is, if there are any modification in the partnership form from time to time, all these modification also needs to be get registered with the uh, registrar of firms. Then only we can convert it to LLP. Then Rule 33, this provides that upon such conversion, the necessary intimation to the registrar of firms or registrar of companies is the case may be, shall be filed in form number 14 within 15 days. So if any such conversion, the certificate has been issued by the registrar. Now the intimation, it is the responsibility of the LLP that this must inform the respective of this registrar of firms or to the registrar of companies that they have converted their firm or company into LLP, and this needs to be filed in form number 14. So this was all with conversion. Now the last leg of our discussion that we would be dealing with LLP taxation. Friends, worldwide, if you talk about, then LLP taxation practice is being done in different type. They are levying the taxations. If you talk about the UK and Singapore, on which edifice our law is based, then the tax is not payable by LLP. There is a tax, there is a pass-through entities, they call it. Tax transparent means though the LLP would be earning, the income would be transferred to the hands of the partners, and then eventually the partners would be paying the tax and not the LLP. So this would be passed through from the hands of the LLP to the partners. If you talk about Belgium, country like Belgium and Australia, LLP is a taxable entity, and over there it is not passed through. So on the first hand, the LLP will have to pay the taxes and so as to discharge its liability. If you talk about the other countries like that of US, it is very flexible. It has left it to the decision of the partners what they want to do. So whether they want to be a pass-through entity or they want to be a taxable entity, it is absolutely up to them. So it is, they can take the decision and accordingly it can be treated. Whereas in India, it is a tax opted juridical entity. In India, the LLP has to pay the taxes, and then subsequently whatever the amount that remains, that is divided amongst the partners or credited to the partners account. So as we discussed, Section 2, Clause 23 of the IT Act was amended to treat LLP as a firm. So they have 223, this has been modified, and for all purposes, a firm would include a LLP mutandis. Section 44 AD is the only exception which we have already discussed. If you talk about the residential status of any LLP, then LLP which is registered in India will be a resident, even if only a part of control and management is in India. So for practical purpose, you can say that if any LLP that is registered in India, there is an Indian LLP, even if a part of control or management is in India, then it will be treated as resident for taxable purposes, taxation purposes. Then surcharge and education cess, these are applicable to the LLP, MAT. So earlier, not earlier, I would say this MAT, there is a minimum alternate tax that was not earlier applicable to the LLPs, then subsequently that was brought in. So company has to pay MAT, that is minimum alternate tax under section 115 JB. However, LLP has to pay AMT, that is the alternate minimum tax. However, practically speaking, see companies when we calculate the book profit, so all these adjustments plus minus are to be done, and invariably company has to pay taxes on book profits as per this 115 JB. But if you talk about the AMT, alternate minimum tax, the number of adjustments that are to be done to the book profit are very few, just like long-term capital gain exemption that was there, or then profits under deductions that are available under section 80H to RRB, and then 35 AD that amortization this. So except for this, there are no items. So literally, if these 3-4 items are not there, then no amount would be added back. Hence, the amount of AMT would be zero for all practical purpose. Whereas the coverage under MAT is far more. So practically speaking, the impact of AMT would be there on very few LLPs, whereas the impact of MAT is almost on every company. dividend distribution tax that is applicable to companies, whereas such concept is not there in case of LLP. LLP are not required to pay any dividend distribution tax. The dividend distribution deemed dividend provisions which are applicable to companies, 222E, this is also not applicable to LLP. So even if an LLP tomorrow transfers any amount to its partner's account for as a loan or whatever, then nothing to be worried about. And subsequently also after making the payment or anything, if they are crediting the account to any of the partners account, then again dividend distribution tax is also not there. So that also we are absolutely free with that, nothing to be worried about. The next important point is profit distributed by the LLP. This is exempted in the hands of the partners. So friends, just like in case of partnership firms, whatever amount that has been earned after making the payment of the taxes, after paying the taxes by the firm or the LLP, so whatever amount, remaining amount that is credited to the partner's account will be exempted. No tax would be applicable on that. Profit earned by the assignee of economic interest is per section 52 of the LLP Act. This is again a new concept, different concept, wherein the economic interest of any partner, he can assign it directly to some third partner. In such cases, since this is a kind of overriding impact, so whatever is not a diversion of income but is an overriding because of this assignment, so whatever amount that would be assigned to some other person, then that would be taxable in his hand and not in the LLP. Then deemed dividend we already discussed. Corporate law provision for inter-corporate deposit. This again will not apply to any LLP. In case of company, section 185, section 186, these are of very harsh nature, I would say. 185, 186. Now, though it has been relaxed a lot because of the various amendments that has come from time to time, but still this provision needs to be administered and monitored. And the section 73, which is again to accept any money, there is again a biggest hurdle in case of companies. So no such restrictions are there, and LLP is free to receive amount from any other LLPs as well as from individuals or others. So again, a company can invite deposits from public as per rules only, but whereas an LLP can receive money from others. So section 185, 186 and section 73 of the Companies Act, that really makes the life miserable at times for the company, wherever in case of LLP there is no such provision. Interest paid to the partners is allowable deduction provided kept at 12%. This is for years now as per Income Tax Act. In case of partnership firms also, maximum interest that can be paid to a partner is 12%. More than that would be disallowed. The only thing is it must be mentioned in the LLP agreement. Otherwise, it will not be allowed. Then section 184 of the Income Tax Act, a partnership will be assessed as such. There is assessed as a firm provided there is an instrument of partnership, that is an LLP agreement is there, and the shares of partners are specified there. So that the shares of the partners must be definite. In case of unwritten partnerships, the deduction for salary and interest are not allowed. This provision will equally apply to LLP. We call it as PFA, as partnership firm as such. Then remuneration, we have already discussed. This should be there in the agreement and on the first 3 lakh of the book profit, or in the case of loss up to 1,50,000 or 90% of the book profit, or in case of loss then up to rupees 150,000 can be given, or 90% of the book profit, whatever it is, and on the balance profit in excess of 3 lakh, 60% of the book profit needs to be given. Next, that is the maximum limit that can be given. In case of retiring partner or deceased partner, share in loss cannot be carried forward in the hands of LLP. This is one view. However, there are some contrary views that are also available, that since this is a separate legal entity with a perpetual succession, so irrespective of that, the loss must be carried forward. Then foreign LLP shall be taxed under the IT Act, not as a firm but as companies. Wealth tax, earlier there was a distinction, but since now the wealth tax has been abolished, so it is earlier where it was applicable to others, but now it is not applicable even to LLPs. Earlier also it was not applicable, now also it is not applicable. So wealth tax is otherwise also abolished. Yes, this is very important, friends. when we talk about the conversion especially, then post 1st of April 2011, the life for conversion was very, very simple and was very attractive. After this LLP Act came into existence, until this 1st of April 2011, many corporates sitting with huge reserves converted their corporates or the companies into LLPs without paying a single rupee as dividend distribution tax. So whatever amount reserves they carried home, so what the benefit for the company was, company on the one hand distributed entire amount, converted to LLP, and the entire amount was credited to the current to the partner's account, and no amount was taxed. So they took the benefit, they evaded the dividend distribution tax by way of effective tax planning. But thereafter government thought that crores and thousands of crores were transferred in such a way which there was a big loss of revenue to the exchequer. Then they came out with an amendment with few conditions, and only if these conditions are in section 4713B of the Income Tax Act, these conditions were brought in. So only and only if these conditions are met, then it will not be treated as transfer. If there is a breach of any single condition, it will be treated as transfer. So, and once this is a transfer, there will be capital gain tax that would be applicable. So the first and foremost condition was the total sales, turnover or gross receipts in the business of the company do not exceed 60 lakh rupees in any of the 3 preceding previous years. So friends, this is the first and foremost condition that needs to be seen. The 3 previous preceding years, this needs to be seen. The turnover of the company should not exceed 60 lakh rupees. If in any of these 3 preceding previous year the turnover is more than 60 lakh rupees, then it would be treated as transfer, and accordingly capital gain tax would be applicable on such conversions. The next item is the shareholders of the company become partners of the LLP in the same proportion as their shareholding in the company as on the date of the conversion. So friends, over here also they need to ensure that whatever the proportion is, the same proportion must be maintained. So if anything needs to be changed, so that needs to be planned well before conversion. Before the conversion takes place, the shareholding or whatever that needs to be changed, that has to be planned, and accordingly that should be given effect to, and thereafter you should initiate the proceedings of the conversion with ROC and not till then. So no consideration other than the share in profit and capital contribution in the LLP arises to the partner. So whatever the consideration that you are receiving should not be any share in the profit and capital contribution in the LLP. So whatever that is coming to the partner should only be the share in the profit and the capital contribution. Nothing else should come to the partners. Then the next one is, so it means that there should not be any indirect kind of benefit that is being passed on to the partners in the LLP. The next one is, as well the shareholders of the company continue to be entitled to receive at least 50% of the profit of the LLP for a period of 5 years from the date of conversion. So at least the 50% of the shareholding which was there in the company should remain same in the LLP. So there can be changes subsequently, but cannot be more than 50%. All assets and liabilities of the company become the assets and liabilities of the LLP. Here also, if there is any such problem with regards to the conversion of entire assets and liabilities, then that should be sold or paid off before you initiate the conversion. So there is ample scope for planning before any such thing is done, and yes, this is possible. Then the next one is, this is recently added. This was applicable only from assessment year 17-18. Earlier there was no such condition. Total value of the assets appearing in the books in any of the 3 preceding year, in which the preceding previous year in which conversion takes place does not exceed 5 crore rupees. So if the total assets value that appears in the book is exceeding 5 crore rupees, then yes, again it would be breach of the condition of 4713B, and there would be, this would be treated as transfer and capital gain tax would be liable. So we discussed this, that no amount is paid either directly or indirectly to any partner out of the accumulated profits standing in the account of the company as on the date of conversion for a period of 3 years from the date of conversion. So there may be a company with maybe 1 crore rupees as a reserve that is there, and on conversion, what is to be done? This 1 crore rupees is the accumulated reserve. This should not be distributed directly or indirectly to the shareholders, erstwhile shareholders, now the partners of the LLP. So these conditions mean that no accumulated profit which are lying in reserve or in the profit and loss account or surplus balances on the date of conversion should be distributed to any partner or transferred to the capital account. Sorry. Otherwise, again, what will happen? This would be treated as transfer. So here, again, one planning that can be done is either you need to issue a bonus share. You need to issue the bonus shares, whatever the amount that is there in the reserve prior to conversion. You can issue the bonus share, so there will be no reserve left with, and then subsequently you can convert. Or else, what you can do is whatever this after the transfer, after the conversion, all these amount which is standing in the reserve should be kept as it is in the reserve account of the LLP, and it should not be distributed. So it is up to the LLP how they plan it. Then total this assets we have already discussed, and LLP is allowed carry forward and set up of business loans to the successor LLP which fulfills the above mentioned condition for a fresh 8 years time from the expiry of the year of conversion, and absorbed depreciation which otherwise also is indefinitely can be carried forward. So for example, here is also a scope for planning. If any carried forward loss is getting expired maybe in the 6th year or 7th year, then in such cases, if the company is converted into LLP, then a fresh 8 years lease of life is given to that loss which is there. FDI. Friends, if we talk about FDI, the life has been made simple for FDI cases. Earlier, it was very much stringent. It was one step below the companies. Those amounts which were allowed or permitted in companies under automatic route were required to be brought in FDI in LLP by way of approval route. But now a condition has been done away with. Now FDI is permitted under the automatic route even in LLP, operating in sectors or activities where 100% FDI is allowed through the automatic approval route, and where automatic route no approval is required and there are no FDI linked performance condition is there. The only thing is whatever this amount that comes in, you have to report to reporting of this is to be done to the RBI. If the money comes in through the authorized dealer, then FIRC certificate, foreign inward remittance certificate, that needs to be filed within 30 days. This is to be done. Then any Indian company or an LLP having foreign investment is also permitted to make downstream investment now in another company or LLP in sectors again in which 100% FDI is allowed under the automatic route, and there again are no FDI linked performance conditions. And this FDI in LLP is subject to the compliance of the conditions of the LLP Act, whatever it is that has to be done. So this was all with regards to FDI, income tax, conversions. Now this is a special case scenario, that is the last leg of our today's discussion, conversion of LLP into private limited company. We discussed conversion of private company into LLP, firm into LLP, limited unlisted public unlisted company into LLP. Now here's a reverse case scenario, conversion of LLP into private limited company. As per section 366 of the Companies Act, the companies capable of being registered includes any partnership firm, LLP, cooperative society or any other business entity formed under any other law for the time being in force, which applies for registration under this part. If we talk about the Companies Act 1956, there was no clear mention of the LLP for conversion, and that is because of the very fact that when the Companies Act 1956 was there, the LLP was not into existence also. But even after subsequently, when in 2009 this LLP Act came, there was no enabling provision was made in the Companies Act. But now this Companies Act 2013 has a clear-cut mention about the LLP Act. It specifically provides for the same. And the other change that is there, earlier in joint stock company for conversion, the requirement was there must be minimum 7 partners. Now, an amendment has been brought in 2017 in the Companies Act, and subsequently with 2 partners also, the conversion from LLP into a private limited company is possible. So for any joint stock company now there is a requirement of minimum 2 partners only. So these are the basic requirements. These are same just like that of a conversion of a company into firm or company into LLP or a LLP into a company. Income tax return, latest copy must be there. LLP agreement, just like whatever agreements that are there till now, these needs to be with us. Then statement of assets and liability that needs to be prepared and certified by practicing CA. Choice of name and DACs, these that all requirements are to be done. These are the various process for conversion, which I don't think we need to discuss. This is self-explanatory. Even you can read through. And another important aspect that I wanted to discuss is the compromise arrangement or reconstruction of LLP. Friends, even just like the Companies Act, here also provision for compromise arrangement or reconstruction of LLP is available. So this is covered in section 60, 61 and 62 of the LLP Act. I would share some of the extract of the provision where a compromise or arrangement is proposed between a LLP and its creditors or between a LLP and its partners. Then first an application has to be filed with the NCLT, and if the majority, which is represented by 3/4 of the total in value of the creditors or members, if they agrees to any compromise or arrangement, and if it is sanctioned by the NCLT, then it shall be binding on the creditors or the partners as the case may be, and the LLP as well the LLP. And in case of LLP which is under winding up, then on the liquidator of the LLP also it is applicable and binding. Then whatever this NCLT order, the sanction that comes in, that has to be filed within 30 days of the passing of the order with the registrar. Even if it is not filed, then this will not be effective. Friends, the provisions of mergers of 2 LLPs are there, but in the LLP Act or in the Companies Act, there is as such, there is no where it is mentioned that a merger of LLP into a company. There is a, I would say, heterogeneous merger. Homogeneous merger is there, but no heterogeneous merger is discussed anywhere. But interesting case that came up before Chennai NCLT, and they dealt it beautifully and made it possible that yes, a LLP can be merged into a company. So provisions of compromise, arrangement, amalgamation, and reconstructions are dealt in with by the Companies Act 2013 under section 230 to 234, and amalgamations are also to be treated in the LLP Act 2008 under section 60 to 62. But then there is, as I said, no explicit mention for dealing with mergers of LLP into company or other way around. We look at the decision of, let us look at the decision of the NCLT Chennai bench, which shall set a precedent in the case of merging of LLP into the companies. So what they discussed, the fact of the case was like the case of Real Image LLP versus Messrs Cube Cinema Technologies Private Limited. So in this case, the Companies Act and the section this LLP Act both contains the provisions dealing with mergers and amalgamations. The wording of the relevant provisions under the above statutes used are almost similar in both the statutes made in LLP as well as Companies Act. Both are similar, and both of them empowers NCLT as the competent authority to sanction the scheme proposed by a LLP or by the company, as the case may be. It was also submitted that under section 394(4)(b) of the Act 1956, there was no bar of a transferor for a transferor company. So if the transferor is a company, then there is no bar. Again, section 394(4) clause B expressly and clearly stated, transferring company does not include any company other than a company within the meaning of the Companies Act. But transferor company includes any body corporate, whether a company within the meaning of this act or not. So when the body corporate word is used, so body corporate includes LLP. So the transferor company can be an LLP, but transferee company cannot be. Then the section dealing with the compromise and arrangement under Companies Act 13 use the word company for both transferor and transferee company. And as per section 220, company means a company incorporated under this act or under any previous Companies Act. However, if you look at section 234. It allows foreign companies to merge with a company incorporated under the Act 2013. So as per 234 of the Companies Act, subject to the provisions of any other law for the time being in force, a foreign company may, with the prior approval of the RBI, merge into a company registered under this Act or vice versa, and as per the terms specified in the scheme. Now, the central government may make rules in consultation with the RBI in connection with mergers and amalgamations provided under this section. So the expression to subsection 2 of section 234 states, for the purpose of subsection 2, the expression foreign company means any company or any body corporate incorporated outside India, whether having a place of business in India or not. So this invariably means a foreign LLP, because foreign LLP is again a body corporate which is registered outside India. So it was concluded by the NCLT that the issue involved in the present petition has been categorically dealt with both by the Companies Act 56, but there is no specific provision in the Companies Act 13. Therefore, this is clear case of casus omissions. So what does it mean? Situation omitted from or not provided by the statute through inadvertence. If the intention of the parliament is to permit a foreign LLP to merge into Indian company, then why it would be wrong to presume that Act prohibits a merger of an Indian LLP with Indian company. Thus, there does not appear any express legal bar to allow sanction or merger of Indian LLP with an Indian company. The court decided, honorable bench, thus that there does not appear any express legal bar to allow sanction merger of any Indian LLP with an Indian company. Accordingly, the petition for the merger of LLP with the company was allowed. And NCLT has rightly interpreted the gap in the law. The order passed by the honorable tribunal is also important from a perspective that since now a LLP could possibly be amalgamated with the company, and this will be available as a new avenue for restructuring. This was only just for the information of the participants that on 16th May 2017 there was an amendment in the amendment rules 2017. So this is effective from 20th May 2017, and application for closure of any LLP can be filed if overdue returns in Form 8 and 11 are filed up to the end of financial year in which LLP ceased to carry its business or commercial operations before filing Form 24. So, if LLP was incorporated in say in 2012, today is 2020, it carried on its operation till 2015. So, if all the forms are filed till 2015 and thereafter nothing has been filed, still it is eligible to file Form number 24 for striking off. Friends, these are the proposed changes that are there in the LLP Act, which I would, these are also self-explanatory. You can go through. I will not discuss more on this. And I think I have taken a little more than what the time that was allotted to me, 2 hours and 2 minutes. I thank you, Virag Bhai and Abhishek Bhai. Hello. 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 Nirav Bhai.
Vikas bhai.
Yes.
Yes, Vikas bhai.
Yeah.
Yes, I'm here only.
Hope I'm audible. Yeah.
Yes. Perfectly fine.
I thank you for this to all the audience for the patient hearing, and I hope I have been able to deal with the subject. And if there are any queries or questions, I will be more than happy to answer all these. Thank you.
Sir, there are a few questions, but I think it's late now. We'll cover that tomorrow, sir.
Okay, no problem. Thank you.
There are a few questions. It's
No
already,
worry.
I mean, more than 2 hours around.
Yes.
We have started exactly at 3. So
Yes.
I think we'll take it tomorrow, sir. Tomorrow session will be, I mean, little less, right?
Hopefully, yes.
Okay. So we'll take tomorrow, or we can take in WhatsApp also, sir.
WhatsApp would also be fine with me. No problem.
Thank you so much, Vikash ji. So thank you all the participants for interactive participation with alertness. We'll meet tomorrow at 3 o'clock. Bhavna ji is there? Bhavna ji, yes, please.
Yeah. Are you hearing?
Yes,
Yes, sir.
we can. हाँ सर, हाँ आ रही।
आ रही है आवाज?
हाँ बाफना जी,
हेलो,
बाफना जी हम आपको सुन रहे, प्लीज।
हाँ हाँ, आ रहा है आवाज, आ रहा है ना?
हाँ जी, हाँ जी।
ओके ओके, it's my great privilege to propose the vote of thanks to our most valuable speaker, honored speaker, Vikash Jain, who is also a CA, IPA, DISA, and certified arbitration, and having a vast experience in company law, LLP, OPC, auditing, IP, and CSR, who delivered an excellent lecture on the LLP, OPC, and CSR with this great elaboration. I don't know that today the CSR or topic is not covered, na?
No, sir, it will be tomorrow. It will be covered.
Okay, okay. So he's very kind to this platform and constantly guiding and inspiring, this blessing the motivation with great vision. And thanks to you again, Vikas bhai.
Sir, we need the blessing of Bapna Saab. We are too young and too small to bless this, but Bapna Saab is always there to guide us and to help us.
The regional council member, active regional council member of WS is very helpful for us.
Sir, the experience of me, Abhishek bhai and Virag bhai putting together is also less than that of yours. So we'll always be blessed to have your guidance in our life and as well as in our professional and personal life both. Thank you, sir.
Thank you very much. Thank you.
Thank you so much, बाफना जी. Thank you, Vikas bhai.
Thank you all.